Today we'll be talking about 3 corporate true crimes that shook and deceived the world without everybody knowing. Number 1. The fall of Theranos, the $9 billion scam that deceived the world. In the early 2010s, Theranos, a biotech startup founded by Elizabeth Holmes, was making headlines for revolutionizing blood testing. The company promised to create a device that could run comprehensive blood tests using just a single drop of blood, something that could transform the healthcare industry. Investors, doctors, and the media hailed it as a breakthrough in medical technology. However, it was all built on a lie. Theranos was founded in 2003 by Elizabeth Holmes, who dropped out of Stanford University at the age of 19 to pursue her dream of transforming healthcare. Holmes quickly became the youngest self-made female billionaire, valued at $9 billion by investors. She claimed that Theranos technology could run a variety of tests like cholesterol levels, blood sugar, and even cancer diagnostics using just a fingerstick of blood. But beneath the glamorous image of Holmes, the reality was starkly different. Theranos technology was nothing more than smoke and mirrors. In truth, the company's device, called Edison, didn't work. The tests it performed were inaccurate, often yielding results that were completely wrong, putting patients' health in jeopardy. Theranos was able to keep the facade going for years due to its massive investor backing. Holmes and her team strategically aligned themselves with powerful figures. Former U.S. Secretary of Defense George Shultz, former Secretary of State Henry Kissinger, and even Rupert Murdoch, the media mogul. These high-profile connections provided the company with credibility, helping to silence critics and garner even more investment. The media was just as complicit, with major outlets like the Wall Street Journal and Fortune praising Holmes for her vision and the supposed success of Theranos. However, behind the scenes, things are starting to fall apart. Employees at Theranos started to blow the whistle, noting that the company's technology was unreliable and that they were being asked to manipulate test results to make the devices appear accurate. In 2015, investigative journalist John Carreyrou of the Wall Street Journal began digging into Theranos, and his reporting exposed the dark truth behind the company's operations. Carreyrou's articles revealed that the company had been covering up serious issues with its technology, and it had misled both investors and patients. For example, doctors who used the tests found that the results were often inconsistent and inaccurate. Some patients received false diagnoses of diseases like cancer, leading to unnecessary treatments. Despite the mounting evidence of fraud, Holmes and her team continued to deny any wrongdoing. However, the scandal began to unravel quickly. In 2016, the Centers for Medicare and Medicaid Services revoked Theranos' license to operate its lab in California, citing inaccurate and unreliable test results. The U.S. Securities and Exchange Commission also filed charges against Holmes, accusing her of orchestrating an elaborate, multi-million-dollar scheme to defraud investors, doctors, and patients. Theranos eventually shut down in 2018, with its assets being liquidated. Elizabeth Holmes and former Theranos President Ramesh Sunny Balwani were indicted on charges of criminal fraud. The case has drawn comparisons to other corporate frauds like Enron, as it highlights how a combination of greed, deceit, and the manipulation of public trust can lead to a massive financial and personal consequences. In 2021, Elizabeth Holmes went on trial for the crimes, facing multiple counts of wire fraud and conspiracy. Prosecutors argued that she misled investors and patients for years, making false claims about her technology and the future of her company. She could face up to 20 years in prison if convicted. The Theranos saga serves as a cautionary tale about the dangers of hype, unchecked ambition, and the lengths to which people will go to protect their corporate image. It shows that even in the world of high-tech startups, the truth always comes out in the end, and deception can only go so far before it collapses. Number 2. Archegos, Wall Street's $100 billion mistake. In the spring of 2021, the financial world was rocked by one of the most dramatic collapses in Wall Street history, not the bankruptcy of a public company, but the implosion of a secretive family investment office with tens of billions of dollars in exposure. The story centers on Archegos Capital Management, a private investment firm run by Bill Huang, a quiet yet powerful figure in finance. Unlike most hedge funds, Archegos was a family office, meaning it managed only the capital of its founder and a small circle of insiders, and was not required to publicly disclose its holdings. Huang had already built a reputation for bold, highly leveraged bets, and by early 2021, he had amassed enormous positions in a handful of major stocks using a web of complex financial instruments, known as total return swaps and other derivatives. These allowed Archegos to effectively control billions in stock without having to reveal its ownership or the level of risk it was taking. At first, no one outside the firm seemed to notice, or at least no one raised alarms. Major global banks were more than happy to lend billions of dollars in financing to Archegos because of the huge fees they could collect. But beneath the surface, the risks were growing exponentially. The key problem was leverage. Archegos was placing massive bets with borrowed money. The positions were not only huge in dollar terms. Some estimates suggest over $100 billion in gross exposure, but they were concentrated in just a few stocks. If those stocks moved against Archegos, the losses would be catastrophic. The trouble began in late March 2021. Several of the stocks that Archegos had heavily accumulated began to slide. When that happened, the banks that had lent money on those positions issued margin calls, demands for more collateral to cover the falling value of the bets. But Archegos was unable or unwilling to post more cash, and suddenly the house of cards began to collapse. Unlike a traditional hedge fund that might liquidate positions gradually, Archegos derivatives contracts forced selling once the margin calls weren't met. The banks began unwinding Archegos' giant positions all at once. The result was a fire sale that sent affected stock prices plummeting and amplified the losses. The fallout was immediate and dramatic. Major Wall Street firms, including Credit Suisse, Nomura, Goldman Sachs, Morgan Stanley, and others, suffered losses in the billions of dollars. Credit Suisse alone reported more than $5 billion in write-downs tied to the Archegos collapse. In some cases, executives and shareholders were left scrambling to explain how such a massive risk had gone undetected in the first place. For Bill Huang and Archegos, the end came quickly. Within days, the firm was essentially wiped out. Regulators and lawmakers immediately began to question how a private investment office could wield so much leverage with so little transparency, and why the banks hadn't spotted the danger sooner. Number 3. The $4 billion accounting lie that shook Britain in 2024. In early 2024, one of the UK's most respected technology companies collapsed almost overnight. Its name was autonomy successor firm Darktrace, a cybersecurity company trusted by governments, banks, and Fortune 500 corporations. But behind the sleek branding and AI promises was a corporate scandal that finally caught up with its founders. Darktrace claimed its artificial intelligence software could detect cyber threats faster than any human team. Investors loved the story. The company went public on the London Stock Exchange, reaching a valuation of over $4 billion. Then the truth began to surface. In 2024, regulators and independent investigators revealed that Darktrace had massively inflated its revenue. The company quietly used round-tripping tactics, a deceptive accounting method where money is cycled through partners to make sales appear real. On paper, it looked like growth. In reality, it was smoke. Some customers were allegedly paid through third parties and then counted as legitimate revenue. Others were offered unusual contract terms that made sales numbers look far larger than they truly were. This wasn't a simple accounting error. It was a pattern. Whistleblowers claimed internal teams raised concerns for years, but leadership ignored them. When the findings became public in 2024, the fallout was immediate. Major institutional investors dumped their shares. Darktrace stock plunged. Trust evaporated. Then came the lawsuits. shareholders accused the company of misleading the public, falsifying growth metrics, and hiding financial risks. Regulators opened deeper probes into whether executives knowingly approved deceptive reporting practices. Within months, Darktrace market value was wiped out by billions. Employees were laid off. Executives resigned. And a company once hailed as the future of AI security became a case study in corporate deception. What made this scandal especially alarming was who was involved. Darktrace early leadership had deep ties to intelligence agencies and elite institutions. That reputation shielded the company from scrutiny for a while. But in 2024, the shield cracked. This case sent shockwaves through the tech industry. It proved that even AI companies claiming transparency can manipulate numbers just like traditional corporations. And it reminded investors of an old lesson. When growth looks too perfect, it usually is. By the end of 2024, Darktrace story was no longer about innovation. It was about how easily trust can be monetized and destroyed. Please like, share, and help me hit that subscribe button below. And don't also forget to turn on your post notification bell after subscribing to get notified when I post a new video like this. Thanks for watching.